Good morning, everyone. Welcome to the UK Finance webinar channel. My name is Lee Hopley. I'm Director of Economic Insight and Research at UK Finance. I hope it's as sunny where you are as it is in South London. And in today's session, we will discuss data strategies to support SME lending. I'm delighted to welcome our panel of experts for the discussion today. We have Ravi Sidhu, Credit Risk SME at Dun& Bradstreet. Francesco Mazzola, Assistant Professor of Finance at ESCP Business School, and Matt Nutt, Principal Consultant Data at Provenir. Just before we get into it, I've just got a few housekeeping items to cover off. Today's webinar will last for around an hour and will combine a panel discussion as well as answering any live questions that come through from the audience today. This session will be available to watch on demand, and you can access the recording by visiting the UK Finance webinar archives or via the same webinar registration link. There'll also be a bit of audience participation throughout the discussion today, so we'll have a couple of interactive polls that will pop up throughout our discussion. If you are having any technical issues, please use the Q&A to contact our support team at UK Finance. The format of this morning's webinar, I'll essentially be Terry Wogan, taking our panelists through the what, why and how of data to support SME lending. It's not just me asking the questions. Please do post any questions that you have for our panel via the Q&A tab. Should note, when you ask your question, your name is not disclosed to the other webinar attendees. We will try and get through as many of these as possible during the webinar, but if you want a fuller answer or we run out of time, we do encourage you to reach out to our speakers or the team at UK Finance directly. So let's get into it. A question for you, Ravi, to kick off. Why is this important topic right now? What are some of the challenges facing SMEs, and what are the particular challenges around SME lending that you're seeing at the moment?
So I think to start off with, there's a few kind of stats that people band around, and I still think they're really important to talk about. So, 99% of businesses are in that smaller end of the market. And so it's quite a significant volume of businesses that are impacted. You've also then got their contribution, so the GDP that they actually contribute to the economy, and that's 25%. I think one of the most telling kind of stats is around the employment. So 60% of employment is coming through that SME kind of group. And that really underlines, how important it is, because if people are taking incomes from these businesses, they're then feeding the economy. And, whether it's a large business, whether it's the medium and small, whether it's consumers, it's all very interconnected. So I think, that really underlines why the SME is a very important part of the ecosystem. I think broader than that, there's a lot of challenges within the market. More recently, we've had a downgrade. The UK itself has downgraded its view in terms of, the economy. The IMF recently has done the same in April. And even when we've conducted surveys, so we have our global business optimism index that we create, and we survey businesses globally. And it's interesting, actually, in the UK, that sentiment has been deteriorating in the last couple of quarters. So that was even before, the other stuff that we've seen at the start of this year that's kicked in. So there was a degree of kind of like cautiousness, and I think we're seeing a lot of impacts of changes. So we got the national insurance, minimum wage, and those are now impacting SMEs. And also we've had the energy kind of costs, and so just inflation in general, that's been there for a while now. There's possible kind of like areas where there could be some hope. We've got rate cuts that hopefully will come through. But I think the thing that everyone is on everyone's lips is the tariffs. They've come down at the start of this year, and whether it's the tariffs, whether it's what comes out of the tariffs in terms of negotiations and what each country will negotiate, I think that's going to have an impact on all businesses, and so SMEs aren't necessarily going to be spared from that. And the view from our economists, and it was a term that they use, and I'm going to use it, which is fiscal health is under strain. Basically meaning our government borrowing is a concern at the moment, and so clearly that's something that is going to affect confidence in the market, investment, and all the other pieces. So, there have been, elements of, support from the government as well in terms of the statements at the end of August, or at the end in the autumn last year about supporting business, SMEs, specific industries that were likely to grow. But I think the feedback in the most recent statement in spring, I think there were a lot of groups that support the SME kind of, or the voice of the SME. And there was a degree of criticism that there could have been a bit more support. So, that really underlines why why SMEs are important, the challenges that they're facing right now. Um, and obviously finance is one part of it. And I don't want to kind of like allude to finance is the only component, but it is an important part for SMEs.
I mean, it just feels like the last couple of years, it's just been one thing after another.
I agree.
SMEs have had to demonstrate an enormous amount of resilience to navigate all the challenges that you've just mentioned.
Yeah.
The pandemic feels like a long time ago, but it kind of it wasn't. What are you seeing in terms of the types of finance that SMEs are sort of looking for right now, as they, sort of continue to look at an uncertain outlook? I mean, certainly what we're seeing at UK Finance, it still feels to be quite a lot of sort of finance to support kind of cash flow, managing costs, rather than SMEs thinking about the sort of the longer term investment picture.
Yeah, I think that's true. I think there's pockets, and you can see that with the various lenders in terms of focusing now on a niche or a particular area. Whereas before you had your traditional banks and they'd have various products. And I still think that when it comes to lending, there's almost like the default option, what's easiest. And what we're seeing through the numbers, and we have various data sources internally that we can see that actually credit card spend and credit card balances were increasing over the last year or so. Um, the net inflows and outflows through current accounts, we could actually see slightly more negative. It's improving slightly over the last couple of quarters, but those are almost like the default options. They're dipping into their overdraft facilities, credit cards, because they have that, and it's almost like, yes, that's good for a short-term fix, but maybe in the longer term they want to be thinking about other options, and those kinds of financing is where they ideally need to be.
Matt, you were nodding.
I was, yeah. I mean, I guess from sort of from our perspective, I think it's that perhaps understanding that there are segments of that market which are perhaps traditionally been kind of underserved in terms of the products and services that they've had available to them, and maybe that's been a data issue in terms of accessibility to data, perhaps for that kind of longer tail of the sort of the SME dog, if you like. It's been definitely I think a challenge, and there's some, but that means there's an opportunity in some of some new sources of data that are available that can help help lenders make decisions to serve this really important segment of the economy.
I think that probably takes us quite nicely onto the question of data. Obviously there are sort of some big questions about demand in the current situation, but why is data important to addressing this, Ravi?
So I think, first of all, data is critical because ultimately, the data, if you've got poor data, you're going to end up with poor decisions. We see it as almost like the fuel that goes through the pipes. If it's a decision engine, then we see it as the fuel that goes through that. Whether it's a credit department, it's the fuel that kind of powers their decisions. So, ultimately, an SME wants you to say yes. That isn't always possible, because if the data is showing something else, then it probably alludes to the fact that maybe they're not quite ready for credit yet, or maybe there's other options that they need to be considering in terms of financing. So it's a fine balancing act. It doesn't always mean that the data being more accurate means that it's going to give the SME what they want. However, it means that you'll be lending responsibly, and I think it's really important that when you're looking at data, there's multiple dimensions. We have 8 dimensions within Dun & Bradstreet that we measure, the quality of data, so the relevance, accuracy, how up to date it is, and it's really important that that care and that scrutiny exists before you, when I use the term you, it's our customers use that data in the decisions that they want to make. I mean, there are constraints within various data sources. We kind of touched on that. So traditionally, we would have used financials, and there are pros and cons to financials. Yes, you have audited accounts, but at the same time, they would be for X number of months in the past. Is that going to reflect what's happening right now? It could be that, we're going through uncertain times at the moment. And so that could be a deterioration. But the flip side is, what if actually things are going better? You can't see that in the financials. So yes, you can send that manually through, but again, that creates almost like another step in the process, a bit more friction. Then you have various data sharing arrangements, CCDS being one of them, whether it's consumer data or whether it's open banking. They all have their, I guess, pros and cons. And to some extent, it's a case of how do you leverage each to the benefit that you need. And sometimes you don't need all of them, but sometimes you will want to leverage on certain data sources, and that needs to be to some extent data driven or analytically driven. So I don't see it as a single bullet in terms of how data can solve these problems. Within Dun & Bradstreet, we refer to it as almost like that unified risk view. You can't just use one data element. But I think, underpinning all of this for me is, and especially for the SME spaces, data in general needs to be more ubiquitous. There needs to be more data sharing overall, whether that's through the customer sharing that information, whether that's through various arrangements that could be put in place, because ultimately that is what's going to drive, better decisions overall. And it's not just, about the lender, it's also about the SME understanding that if my data is out there, they have the confidence that each lender is going to be taking everything into consideration. So they know that it's going to be a fair decision at the end of the process, no matter what it may be. Ultimately, they want to say yes, but yeah, that would be the ultimate aim.
I mean, I think particularly it feels like at the moment SMEs aren't just looking for a yes, but they're looking for a decision quickly. So, I guess from what you're saying is that, this approach to data sharing and SMEs being comfortable with that actually gets them the right decision, but it also gets it when they need it.
Absolutely. And they don't, I think we all have been, we've all seen the benefit from the consumer side. And so from a consumer lens, nowadays, if you were to apply for credit, you wouldn't be expected to wait a week. And consumers and SMEs, they're just people. And so you have the same expectations. And so the SME space is almost going through that same change. And I think it's really important that lenders understand that, because it will be part of the decision making when it comes to, who will I go to if I want credit? I'll go to the place that makes it easier for me. I will go to the place that will give me that credit quickly, give me the right limit that's appropriate for what I need or what I think I need. So, those factors come into play.
This transition from a kind of, I guess, a retrospective data view when making decisions towards a more sort of real time view is definitely where we are going and should be going in terms of making those decisions. And I think to your point about the data sharing as well, Ravi, I think that it's that the SMEs understanding that value exchange between what they get from things like open banking and making things available. Again, to your point, yeah, it doesn't always mean that they're going to get the decision that they want, but we're reinforcing that kind of, I guess, transparency around the decision, and more importantly, making sure that things are affordable and appropriate for that customer.
Yeah, and I think it's a two-way thing as well. I think SMEs need to understand the benefit, so there's a bit of an education element around that as well, in terms of, we're not, large organizations are not just taking this data for their benefit. Ultimately, it benefits the SME. They need to understand, in the return, how can they get visibility of their own data, because it is their data. And so they're understanding that and understanding how it's going to be used is really important. I think we've come a long way in the consumer world where people understand that I've got to pull a credit report on myself before I apply for credit. It's no different for the SME. And I think that's starting. I'm not saying it's not happening, but it needs to happen more.
Right, I'm going to bring Francesco in just a second to talk about some research and open banking. But first, our first bit of audience participation Just want to get a sense of those on the webinar, what data sources you use for lending decisions. Tick any and all that apply here. Right. Kind of frantically pressing buttons here. Just give it a few seconds. Answer is still coming in. I think we're all there. Right, so top is kind of, as we discussed, company financials, then consumer data, followed by CCDS, and then open banking just over a third. Any surprises there?
I guess not necessarily surprised. I mean, you'd expect financials to be there. I think it's interesting because when people talk about open banking, yes, it's very important, but I think that almost those foundational layers around the financials and starting with that as the base, then looking at other data sharing, and then looking at the, I guess, almost at the margins or that those pieces of information that would make a difference. I think it's interesting that, there wasn't more on the open banking space, because I think there's a lot of interest around open banking, but I guess adoption isn't quite there yet for all sectors, and maybe it's not relevant for all sectors as well.
I think that leads us nicely into Francesco. So you and some academic partners have assembled the first comprehensive database on government initiatives to establish open banking. And you use data from the UK, which is an early adopter, to show how such data sharing policies have affected individual consumers and small businesses. Do you want to tell us a bit more about the key takeaways from the research?
Sure. So first of all, thanks so much for having me today. Thanks so much, Lee, for the questions. And to introduce my research, let me also following up on some of the aspects we were discussing before would be kind of a good introduction on the frictions aspect Ravi and Matt was mentioning to emphasize more data sharing policies we need, and speaking more broadly about why we need government intervention for financial data sharing in the first place. Okay, so when it comes to the process of sharing bank transactions and payment data with third-party financial providers, there are considerable frictions, right? First, think about the absence of an infrastructure. This can make the process cumbersome for SMEs. Consumers may not fully understand what they are sharing with whom or for how long. Second, think about banks themselves being reluctant to facilitate data transfers to competitive or security concerns. And this can even reinforce data monopolies or market powers. Third, API formats or functionalities may vary across financial providers, right? Think about the lack of standardization, for example. And all these inconsistencies leads to broken or incomplete data sharing, frustrating experiences for businesses in the end. Okay, and this is why market forces alone may not be enough. We need some government-led effort. That is why UK government, as well as many other governments across the world, are very keen in intervening with some implementation of data sharing policies. And let me emphasize, these are extremely important for business and as well as for economic growth. Okay, so through data sharing, policymakers aim to boost things like innovative entry or competition and even financial inclusion. Okay, so a little bit of this introduction lead me to my research and to share some of the takeaways of my recent article we published at a leading academic journal. Okay, so I collaborated with some professors at various universities in the UK and the US. And as Yuli mentioned, we have assembled for the first time this database, global database on government initiatives to establish financial data sharing policies. Think about open banking, but also small deviations from it. What we conclude from the research is that this kind of policies is becoming ubiquitous internationally. So more than 80 countries globally are taking some steps towards this type of policies. And the second part of the paper, we use data from the UK, which again is, as you guys may be aware, it would be one of the earliest adopter of these kind of data sharing policies in the world. And what we do, we show how such data sharing policies affected small businesses, which are very important for the economy. Now, more concretely speaking, what we do in the paper is to present some specific evidence from a UK policy targeting small businesses, the so-called famous Commercial Credit Sharing Policy, or CCDS scheme. And I'm sure many of you already are familiar with this scheme, but in short, basically CCDS, what it does is, was introduced in 2016 and applied only to SMEs with annual sales below 25 million pounds, okay? And so this cutoff allows us to compare outcomes for so-called eligible versus non-eligible SMEs around the threshold. And we track their credit relationship formation over time across this threshold, close to the threshold. And what we see is that the policy has increased competition from the lending side, and brought even some financial benefits to SMEs in terms of lower interest rates on new credit products. So this research has been even picked up by the HM Treasury, latest post-implementation review about CCDS, and hopefully will be relevant to the upcoming publication of the second post-implementation review on CCDS scheme.
I mean, quite often the UK is an early adopter of things, but doesn't become a sort of leader, doesn't sort of run with it. Do you get the sense that this is something that the UK government is sort of taking seriously in terms of driving forward?
Yes, I think it's, I mean, of course, there are some potential, let's say, aspects to improve. In the paper, we show the benefits of this scheme, and actually the fact that the research has been picked up, our research has been picked up by the HM Treasury, and so they are hearing a lot of views and feedbacks from stakeholders. So this is very good for improvement. Okay, so they are open to hear feedbacks, and so this is good for hopefully improving these policies.
Yeah, I was just going to add to that. So there is a working group for CCDS, and we have these conversations regularly with our competitors, and actually we're doing it for the, I guess, the benefit of the industry overall, that making sure that this data, one, that the data is accurate, up to date, and all of those kind of base standard elements are clearly important. But then, we have customers that come to us and say, can we use this kind of data for a particular use case? And so quite often, the use case that you can use it for is credit. You could, in theory, look at your suppliers, and that's quite topical now in terms of suppliers with tariffs and all the other things that are going on. So, there are various use cases that we'd like to extend it to, and those have to go through these reviews. So I guess, yes, what has been implemented from a CCDS perspective is really good. It's good that we have this sharing arrangement. If I was to be critical, then I'd say we have 9 designated banks that are mandated. Things have changed in that time, and I think actually, could we have actually, you've got challenger banks that are much bigger now. If I was to go back 10, 15 years, the proportion of the market in terms of lending, it was 80% in favor of the traditional banks, 20% alternative lenders. More recently, 50-50, maybe swinging more towards the challenger right now in some ways, 60-40 potentially.
Yeah, I think that's what the BBB report, their SME market report, suggested. It's now 60-40.
Yeah, so it makes you realize that actually, in order to continue this good work, those need to be incorporated. So to some extent, and there was a paper that I kind of wrote with Mike from UK Finance previously, and it was almost about how do you continue this iteration of the rules, because once you legislate, those are the rules and everybody has to adhere to those. But how do we evolve? And the truth is, that's what we want to be able to do. It's the evolution of these schemes and how you can then kind of move with the times almost.
I think that brings us to our second poll. which kind of links to the moving with the time. So there we go. What are the barriers that you face in moving to new solutions and architecture? Again, tick as many as you feel appropriate.
And just while people are filling those questions in, I think the other thing that's quite telling, and Francesco alluded to this earlier, other markets looking at schemes like CCDS. I mean, internally within Dun& Bradstreet, we've had colleagues from other markets talking about, so how are these arrangements set up? And so in the UK, there is obviously CCDS, and we are part of that scheme. It's government mandated. In the US, you have different kind of setups where, we have our own proprietary database in the US, and there is a shared one, but equally there's one in Hong Kong, and other markets are looking at that now. So it's not just, I guess, open banking, but it's also those sharing arrangements.
Quite even here in terms of barriers. Budget and change management just coming out top. But I mean, it seems like the issues are sort of multifaceted.
Yeah, and I guess that, to some extent, even the business case and budget constraints, to some extent, you could say are linked. And I think everybody has difficulty managing change. But yeah, it's quite interesting that it's just about everything. There's a lot of problems by the looks of it.
Yeah, well, you started with there's no silver bullet solution, and there's a kind of myriad of challenges and kind of figuring out how to navigate that. Which kind of brings me to Matt. I mean, we sort of talked at the top of some of the challenges that SMEs have faced. I mean, it sort of doesn't look like those are going to subside anytime soon. We keep thinking we see a light at the end of the tunnel and then realize it's another train coming towards us. How can financial organizations kind of try and stay ahead of the curve with some of the things that we've talked about?
Yeah, I mean, so I guess from a kind of a technology perspective, certainly the kind of the usage of cloud-based platforms is very much the kind of the way that the industry is going with these things now. So what that allows you to do is essentially get more kind of operational efficiency. So by adopting these types of platforms, you can kind of most of these things will allow you to kind of look at workflows, to look at kind of potentially streamlining things around that. But I guess the most important thing around that is that they're agile. They allow your business to kind of flex with depending what those conditions are in the marketplace at the moment. And then you couple that with kind of some of the kind of the innovations around using AI and analytics to sort of be monitoring the performance of the things that you're doing, effectiveness of models, all these kind of things help you adapt and change certainly credit strategies from a lender's perspective, and basically get better outcomes. And I guess I suppose the third element of that is the type of thing that Ravi's been talking about in terms of that data, whether that be kind of, I guess, the traditional data that we've all been using for making those data-driven decisions, but also to stay ahead of the curve is kind of looking at those. Are there new sources that can help make those decisions? And again, the data in terms of open banking that the guys have been talking about this morning, all of these things in terms of transparency around those data should and could be helping the customers and helping those small businesses in the very challenging kind of and changeable economic conditions that we face at the moment.
I'm quite surprised that it's taken us to nearly half an hour into the webinar before there's been a mention of AI.
We're holding it back.
Yeah.
Francesco?
I mean, it definitely isn't. It's definitely a sort of that's the drive. That's the way the industry's going, right?
Sorry, Francesco, anything from
No,
your research point of view? No. Okay,
you
great.
know, I agree very much with Matt, what Matt said about the technology part. So I think being able to observe inflows and outflows of the, customer checking account and, offering payment services, this allows lenders to estimate really cash flow in real time.
Mm.
And this is true also for small businesses that do not borrow. Okay, so let me stress this aspect. Survey evidence suggests that more than 60% of SMEs do not even have any lending relationships, right? Which means that without CCDS or any kind of non-credit data sharing policies in place, it would be very difficult for lenders, or at least they would have a very partial view, limited view to assess financial positions and credit risk of those SMEs. So in our research, I was mentioning before, the way we look at these relative rates of new secure career relationships is actually some sort of strong and significant results, right? So we found that the policy, for example, raised the relative likelihood of an SME obtaining a new loan from a new creditor, so someone outside of their existing creditors group, by approximately 1.5 percentage point, which is pretty large with respect to the average relationship formation rate. It's about 25% of this average. And then what we find is that these new relationships are concentrated among non-bank lenders, defined as those institutions that do not take any deposits, such as fintech lenders or these niche type of institutions we were discussing before. And then what we also look at some sort of distributional effects, and we find that these firms that use CCDS are benefiting more from those that have already some existing lending relationship benefit more, and eventually manage to pay less interest rate. So overall, what we show in our research is that the scheme promotes competition, limits adverse selection in credit markets, and stimulate economic growth.
I just want to come back to a point you made at the start there about the cohort of SMEs that don't have any borrowing and are sort of classified as permanent non-borrowers is significant.
Right.
And there's lots of reasons for that. Some of them don't need it, some of them don't want to. There's discouragement that happens. And it's definitely something that the government is consulting on in its kind of SME strategy and around access to finance. So I kind of hadn't joined the dots between the two things, but that actually this feels really important in the context of that group.
Yeah, it's
Right.
an interesting report, and I in the I think it was the British Business Bank, I was looking at that same point around which areas of the market, and they had various breakdowns by whether it was the demographic, whether it was the background of the SMEs, and there were certain areas where they were less likely to take credit. And I don't know whether it's cultural, I don't know whether it would be more related to trust, whether do you trust taking that, or whether there's a fear, if I take credit then I have to pay it back. Maybe I keep things small, I manage things. So not everybody wants to be the next unicorn. Not everybody's looking. So I think we could be mindful of that as well. But I think it's still a relevant point. I just wanted to go back to a point when we were talking, I guess, about the technology aspects of things, and I know that Matt was talking about how things are cloud-based, and you've got these full-blown solutions. Obviously, the Provenir solution being an example of where organizations can actually use technology to kind of really improve things. What we find in terms of the lending market, there's lots of niche lenders. There's lots of smaller lenders, and actually not all of them are necessarily at the point where they're ready to scale up or make that massive investment. So I appreciate that there's a big proportion that clearly Provenir and solutions like that would talk to. But we have organizations that pull reports and then judgmentally review those. So the question, I guess, for us is, how do we help them move up that one step on that maturity curve? How do we make what would take a couple of days, maybe just a couple of hours? And so, those are the other considerations. How do we pull the information into a format that it's consistent for an entire team to actually end up with those decisions? to be accurate and consistent. So, you know, there's manual, there's partial automation. I think we shouldn't just discard that. I think that's important in terms of how you move up, because organizations will not be able to scale by making massive, not everyone can make the massive investment. And I think that's something important. So it's about helping everyone just move up that maturity curve.
Before I ask the next question, just a reminder, it's not just me asking the questions. There's a couple of questions that have come in, but please do drop your thoughts into the Q&A box, and we'll try and get to those shortly. I mean, we've talked about the what and the why of data, so I guess it's the how, and we're sort of getting into that already. But Matt, the practical do's and don'ts in relation to innovation in this space.
Yeah, I mean, I'll kind of talk generally, I guess, to this rather than from a Provenir perspective.
Or you can do both.
Yeah, okay. I guess sort of what I would sort of say from a do's perspective is certainly if you're using third-party data or internal data, the first thing to do around this is basically get your data house in order. You know, your kind of data needs to be clean, it needs to be accessible, and it needs to be compliant, basically. And so that feeds in, I guess, to the second point around this is, you know, any of this kind of innovation around data, it has to have compliance and good data governance sort of built into what you're doing. It's much easier to work with your legal and your compliance teams at this innovation point and make sure that things are you know, right, and you're doing the right thing, rather than trying to fix something later on when you think you've got a really nice data set, and then you realize that, you know, you can't then use the AI to leverage the benefits in that data because there's sort of compliance concerns around that. So it's always better to have compliance front and center at what in terms of what you're doing. And then I guess I would sort of say that certainly my data science team kind of internally would be saying the thing that's really important around this is test and learn. Sort of do things and do it in an agile way. You can see the effects of what you're doing, and again, using the kind of the data and the technology that we've spoken about this morning, it means you can basically you can learn quickly, and you can adapt to real world situations. So I guess I would sort of say they're the kind of the main do's from a headline perspective. From a don't do perspective, you know, again, I guess this. Make sure that don't forget about data privacy. You know, that's again feeds into the compliance thing. That's super important in everything that we all should be doing. And it was really interesting seeing the kind of the poll results from earlier in the webinar, because I'd kind of put as one of my kind of don't do's was don't innovate for the sake of innovate, right? If it ain't broke, don't fix it. You know, if you are going to innovate, make sure that you've got a clear kind of business case for what you're doing. Don't go kind of chasing the you know, you've heard the fancy buzzwords on a webinar on a Wednesday morning. You know, it's make sure it's going to solve a problem for you, and I think they would be the kind of things that I would be thinking about when planning to do things.
There's probably a question that it's from the listeners that it's worth sort of picking up now. The best approach to integrating new technology into old processes. I guess, you know, some startups will be born data driven, but most won't. So what's the starting point? That's probably a webinar on its own, but
yeah, it's
kind of a few initial thoughts.
It's a good question, and I guess I would, you know, with my Provenir hat on, I would say, well, you know, that's literally what we do. You know, we build API connections to allow that pain to be taken away, and other organizations do too. That's what we do, but allows that, having that kind of implementation of a technology layer on top of legacy systems to orchestrate data is a really important sort of task. But it is that kind of you're then integrating kind of one API into a provider like ourselves, but then getting access to all sorts of a kind of a, if you like, an agnostic data ecosystem of things that you can pick and choose, what you want to do. So certainly, yes, a lot of the work that we do in this from the technology provider's perspective is that kind of helping people who have got those kind of traditional systems. How do we join those legacy systems to the kind of new and exciting stuff? So yeah, it's not always easy. And yes, I think to Ravi's point earlier, certainly there are challenges for adoption for the smaller end of the market, but there are solutions along that kind of value chain that are available. So look what's appropriate and when making these decisions.
Right, let's go to our final polling question. Have we got the final polling question there?
Lee,
Webinar support.
Yeah, just as you bring that up, I was just going to add something to the previous two questions, actually, that, Matt just kind of made me think about. So, when we talk about, we talk about data, we talk about technology, and then there's the analytics. And so that's almost like that whole cycle of constant improvement.
Yeah.
So I think, it's almost like that three-legged stool in terms of you need those components. And sometimes people don't have the analytical capability internally. And so sometimes, like, for example, we perform retrospective analyses for our customers to say this is how things could improve within your book. So mindful that the poll is going on in the background, but
yeah.
And then the other thing was really around, as you start automating, I think one of the things that people need to be mindful of is fraud, because no longer are people, and very good people, looking at things and just identifying things that don't look quite right. But when things are fully automated, then the chance of fraudsters finding a loophole, finding a way to kind of circumnavigate that is going to be higher. So that's why we've also been looking at, other data sets around triangulating and looking across those various data assets. So we refer to it as high risk signals within the organization. So where, for example, the financials don't tie up with what we're seeing through CCDS, for example. And we've got the results of the poll. So
we do.
Wow.
Wow, this is pretty clear cut, this one.
Yeah.
Very clear.
Clear winner.
Yeah.
Is that surprising?
I think we'd have to have a look at the audience as well in terms of like who's responding to it. I mean, yes, I guess it would. Yes and no. So I think everybody's looking for that next iteration. That's really positive in some ways, actually, as well, because I think you can do a lot more with, for example, our data if you have the solutions that can ingest it, process it, because if you've got lots of data, sometimes it's more confusing. What do I use? How do I use it? How does the analytics then drive that? So it's positive that that's an outcome that that will happen there. But Matt, I think this is for you to kind of comment on more than anything else.
Yeah. Well, there's your AI use case, isn't it? Sort of plowing through the vast amounts of the data and kind of helping you kind of see the wood for the trees, so to speak, and be able to kind of to Ravi's point there, help pick out the things that are key and relevant for that particular customer or that particular use case within that customer, so that it can be used as effectively as possible.
Someone's just dropped a point into the chat, actually, which I think speaks to that, which is a lender tries to access a funding application through affordability, CCDS, and company financial information. This means there's a lot of data being consumed, and it's important to avoid death by data and optimize what's being consumed to ensure the efficiency of the lending. So, I mean, that sort of speaks to that point, I think.
Yeah.
Absolutely, and that's why the analysis and being able to synthesize that data and getting back to what is really important, because otherwise it's just a lot of things that could be conflicting, may not be relevant. and that's what you have to read through. But hopefully the data-driven approach,
Yeah.
and that's what we want people to adopt, is the way to go forward with this.
I mean, definitely that's what I mean. My data science colleagues would be saying, you know, part of that function is curating that data to because often the customers kind of go, well, we don't know what we don't know, and we don't, you know, all we can see is all these points, and what's the, you know, which one should we focus on, and I guess what you can do is increasingly what we're seeing now is the blurring, and you spoke of this a little, Ravi, to the blurring of the lines between stuff that we would see as kind of traditional credit risk versus stuff we would see as fraud, and the, you know, the usage of those, I guess the blurring of the lines between those teams or those two functions, and
Yeah.
you know, and the data that's associated between those, that there'd be a kind of a, if you like, a Venn diagram of stuff that you can use for both of those use cases, and help use that more effectively.
I mean, the future is just going to be more data rather
Yeah.
than less. So
Yep.
it kind of feels, well, everyone's sort of looking at technology. There's
Data's
going to be
king.
more to it than that.
Yep.
I guess it's important to look down the other end of the telescope. I mean, and we've sort of talked about this a little bit, just in terms of what the SME experience is going to be on the back of this. So there's a bit about sort of speed and decision making, but I guess they're sort of making that feel real for the borrower, or the firms that that lenders are interacting with. What's the sell?
In terms of, sorry, rephrase that.
The sort of benefits to the SME journey.
Yeah, I think we touched on it, I guess, earlier as well. So, you know, the speed of the process, getting access to finance quicker, setting expectations. I think, you know, there's the capability of actually having a view of your own credit before you apply, and that manages your expectation in terms of what you can then get. So I think having the information that the lenders can see is only one part of it. Getting that data in front of the people who actually have, you know, they own that data, that's their data. They should be able to see that. And so that will help them to some extent actually navigate, you know, if I'm paying someone late and I didn't even realize that it's going to have an impact on me, I'll do it within terms, because they never really made a fuss. They never called me through collections. I always had that flexibility, but that's getting reported somewhere. So I think, you know, understanding how that makes a difference is really important. And that's where, again, you know, from a D&B perspective, you can have a look at your own credit. You can actually have a view through credit insights. And I think we need to encourage that more. We need, you know, SMEs to understand how that will, you know, impact the decisions in the end. And I think that really will kind of close the gap, because that's what we need to do. It shouldn't just be that one side is holding all the cards and understands everything that's going on.
Yeah, and I guess I was going to add that I guess what you'd say, you know, we talked about the economic conditions throughout the call. You know, you've got, I guess, what this means is then the risk window for the lender is in some cases is narrowing. So having that real time data is going to benefit the lender, but also that kind of speed and agility is going to help the end customer, because they may well be able to see an opportunity in the market for them, and if they can't get access to that invoice financing or whatever they need, it means that they're not going to be able to. So it's definitely a kind of a, you know, if we get this right, there's a win-win for both the SMEs themselves and the lenders in terms of using this in a positive way.
Yeah, and you know, we do want that speed and we do want that agility. The thing that always comes in my mind, because I'm working in risk from before, I do think about the controls, the fraud, and all the other pieces as well. So as much as speed is great, you just need to make sure that you have the other components in. And just because you haven't experienced fraud in the past, in the new world, it is, you know, you're likely to experience and come across this more. So I think it's a really important thing to be mindful of, and being, you know, open to new data sources that might highlight these risks.
Questions just popped up in the Q&A. What are the merits, and how should SME think of third-party integration like Provenir than building a credit engine in-house internally?
Horses for courses is the honest answer, and I could probably talk about for an hour on this point alone. there's gonna be yes, if you've so a lot of people will adapt an internal process and do that. Then there gets a point when again it's probably around like I talked about before, operational efficiency, scalability, all of these kind of things. When a business is at a particular size, when using a third-party technology provider who can manage those APIs. So for example, I would sort of say that a lot of the kind of say the tier one organizations that we would work with, a lot of the benefits for them is because it might take 9 months or a year to get them to get IT resource to do something to integrate a new data provider, for example, whereas we can do that in days. So it's that's able to respond to things. So there's that side of the kind of things as well. Getting access to those new data sets and doing that, but equally, I guess some of those kind of bells and whistles, if you like, are not going to be appropriate to a small organization, and they could well be able to do things. So there is I guess there is a tipping point in terms of what's appropriate, and there are other solutions that are available other than ours, which serve different segments of the market. So there's usually something for somebody across whether you want to just kind of put your toe in the water, or whether you feel that you've kind of outgrown an internal solution.
I'm completely sold on the benefits of this approach from the SME side of things. But as you said right at the top, Ravi, there's millions of them, and they come in all different shapes and sizes. It's that how do we, and this is an impossible question, but how do we go about kind of telling the story and influencing the decision making of many of those businesses?
So in terms of credit and trying to get credit into the hands of SMEs.
Yeah, and sort of understanding their own data and being sort of open with it.
I mean, I think first of all, as an industry, we need to be, whether it's through UK Finance, whether it's through our own channels, we need to be kind of reaching out and actually making sure that this kind of insight is available to them. Whether it's the data sharing schemes, I'm pretty sure that SMEs wouldn't even have a clue what CCDS is. They wouldn't know that their data is being shared. So I don't know whether that's something that should and could happen, because ultimately them understanding that this data is being used and understanding the benefit of it will actually probably even help in the kind of goals that we have in terms of we want data to be shared more broadly. Like they might go to their bank and say, so why aren't you sharing my data? That you've got all of this information. I've gone to another lender and I've not been able to achieve this. So I think just making that general awareness. So at the moment we talk as an industry, but the SMEs know nothing about this. They know nothing about the CCDS scheme. It's just an acronym.
Yeah, I think I agree. I think beyond coverage, what Travis mentioning, there are a couple other points. It's important to emphasize simplicity and standardization. So kind of regulators, if you want, should emphasize simple user experiences, easy to use jargon-free interfaces, but also consumer protection. I kind of 100% agree with what Matt was mentioning before. This is key and should be priority. So making sure that rules are clear on fraud prevention, liability, dispute resolution, these kind of things are in place to boost trust and improve customer retention.
Right, we're coming up to the hour now. So before I wrap up, is there anything that you wanted to say in this webinar that you haven't had a chance to air? So kind of speak now for final thoughts.
I think a quick one on the benefits of these data-driven strategies. We may have forgotten the fact that SMEs can receive fully personalized financial products, right? So not only fast and very quick decisions, but also fully personalized. Lenders are being able to observe full financial picture of an SME. This is important because they can help clients navigating complexities in today's markets, very competitive, from supply chain disruptions to cash flow gaps, forgotten subscriptions, or think about complex payments. And all of these can eventually lead to better and more personalized financial service offerings. Okay, so tailored to the SME specifically, fully personalized financial solutions. So I think this is quite important also going forward with more data sharing policies and going from open banking even to open finance or other type of financial products brought into the picture. And this will be kind of into 5-10 years from now, or even less, who knows.
I think the one thing I was going to mention was, from all the discussion that we've had so far, we've started off with the fact that there's been a lot of uncertainty in the market. I think if there was ever a time that, you would focus on how organizations need to adapt, now is the time that, if you're talking about it internally within the organization and you're talking about business case and trying to get traction, if there was ever a time to kind of think about it, that it's now, because you do need to adapt. Things are changing very quickly. We think we're going to go into a smoother period. It doesn't seem to really happen, and you just need to be ready. And so therefore, whether it's the technology, whether it's the data, you just need to be able to move to a strategy and be able to implement it quickly and react, before these things really will impact your business. So I think everything that we talked about today is even more so relevant.
I was just going to add, and I guess what the guys have just said is it sort of feeds into this as well. A lot of the things that we see are people kind of coming in and basically trying to automate or semi-automate a lot of kind of still manual processes. So I guess my kind of final thought on this is kind of, we don't need to shoot for the moon. There's some kind of little wins in terms of making, so you don't need to think, oh my gosh, I've got to go from here to here. There are some things in terms of if we can automate some processes, if we can help get access to some data that perhaps was not structured or not available, there could be a little win. You're not talking about completely changing your infrastructure in terms of data and analytics, or in fact implementing one.
And on that note, I'm going to thank you all for what has been a really, really interesting discussion. I think you've made a strong case for a data-driven approach, and also for really thinking about it now. And I hope that participants will have taken away some sort of practical tips on kind of how to kind of take this forward within their own organizations. So I just want to thank our panelists and you all online for joining us today. Thank you for the questions that came in. We will email you a copy of the recording and links to our upcoming webinars. I do hope you can join us for our Digital Innovation Summit 2025, Innovation for a Better Society, on the 24th of June. This will be with fellow industry leaders, policymakers, and decision-making for a day of actionable insights, transformative ideas, and unparalleled network opportunities. And with that, thanks very much. Have a great day.